Hey Rajan, hello. Welcome to EngageMint, and thank you for joining us. It's a pleasure to host you today for this event. But we're glad to have you here.
Yeah, thanks. Thanks, Avlesh. First of all, Engagement is one of my favorite events of the year. I'm really sorry I can't join all of you in person, but I'm glad we can do this virtually. And hopefully all of you will have an incredible day.
Oh, absolutely. Thank you so much for all the love, Rajan. Yes, we have a great day lined up, and we look forward to a bunch of these very intense sessions. But getting directly to the point, Rajan, and because you've been talking very vocally about this. So amidst all this gloom and doom in the venture capital world that's been going on for the last 18 months or so, you continue to stay very optimistic about India's startup potential in general. What's the reason for your optimism?
So I think first and foremost, it's important to keep in mind that, the goal is to build enduring companies, right? And the most important thing about an enduring company that it is profitable and it over time generates significant amounts of profits, right? So I think what's happening in this current period over the last 18 months is every startup in India is focused on, especially late stage startups, okay? Like for instance, companies like WebEngage and many others. Are very, very focused on improving their unit economics, building fundamentally better businesses, and obviously many are actually getting to profitability. So I think the first reason for excitement is, look, in an area where there's plenty of capital, okay, it's easier to grow. Look, fundamentally, look, I've run many businesses over 2 decades across software, across internet, across hardware, right? It's easier to grow revenue than it is to grow profitably. Okay, growing profitability is the ultimate objective. It's not just to grow revenues. And I think the first reason I'm very excited is this current environment is getting all our sort of, let's call them growth stage companies, right, to focus on getting to profitability. Many of them are already getting there. Others are sort of well on their way. So I think that's one. I think second, look, these periods are the best periods to start up. They're also the best periods to invest. Why are they the best periods to start up? Because if you're starting up in this sort of market, you're very, very serious about a problem that you want to solve, right? We are not going to do it just to kind of raise a lot of money and then get going, right? It's sort of get real time. So the kind of founders that we're seeing in this market, Ablesh, are just orders of magnitude better in terms of they come with deep domain expertise, they come with deep insights into the problem that they're trying to solve, and they're getting into it eyes wide open, right? Meaning, it's not an easy time to build a company. So I think it's a great time to start up. And by the way, it's a great time to start up because there's a lot less competition, right? There aren't 25 entrepreneurs trying to go after the same idea, right? Usually you got an idea, you're probably going to be the only game in town for some period to come. Over time, if you're successful, others will also try. So I think there's a lot less competition. And finally, look, if you can, like, let's say you're in a B2B business, right? You guys are in a B2B business. In this market, if you can get customers to pay you, meaningful amounts, right? Could be, 10 lakhs, 20 lakhs, 30 lakhs, 40 lakhs if you're building software. You'll build something valuable because, in this environment, companies also being very, very focused on ROI, etc. So I think that's, and then in terms of investing, this is the best time to invest, right? Companies are very real, valuations are normal, and so on and so forth. And then the last thing is, look, everybody's sort of very focused on this funding winter. Look, the reality is we had two exceptional outlier years, okay? 2021, where India got over $40 billion of funding, and 2022, primarily because of the first half, where we got over $20 billion of funding. If you take those 2 years out, over the last 15 years, Ablesh, we are pretty much on trend line. Okay, this year we'll land somewhere between 10 and 12 billion. Maybe it'll be 9 billion, depending on how Q4 goes. And if you ask me at 10, given the state of our ecosystem today, it's 10, $12 billion, and it'll grow, at the normal rate that it should. Is that a good place to be? I would say actually it's a pretty good place to be. Now, of course, if you're pegging everything to 2021, which was like a once in 100-year summer, okay? You can't look at a once in 100-year summer and then say, oh my God, it's all the summer, because you're comparing it to this once in 100-year event. So 2021 ain't coming back. This is the way it is, right? So whether you're entrepreneurs building companies or whether you're investors, looking to invest in companies, this is what it looks like when it's normal.
So what I'm clearly hearing, Rajan, is that so we're not going back to our exuberant days once again, right?
Short-term memory is very powerful, So this ain't coming back in the next couple of years. Look, once a decade, we'll somewhere towards the end of this decade, early part of the next decade, are we going to see another period of exuberance? Yeah, probably. I mean, those are the cycles that we go through, not just in technology, by the way, in real estate. I mean, it happens in every asset class. Like look at what happened in crypto, right? Crypto has had this major boom cycle, and now obviously crypto is going through what it's going through.
So is the advice go back to basics per founder?
Yeah, just focus on fundamentals, right? Make sure you're building products that your customers really, really want. Make sure that you're making money on every order that you're selling, or if you're selling a software company, every customer you're making money on. Make sure that you build a great team. Make sure that you have a great culture, and focus on building a real company. What do companies do? Companies have great companies have great products that their customers love. They have great retention. I mean, we'll talk about that in a bit. They generate lots of profits, and they have teams that are very, very capable and cultures that are extraordinary. If you just focus on the fundamentals, you're going to do just fine, right? But it's not a period where you can, drive growth for the sake of growth, or, drive growth because you're going to raise your next round. Because the reality is, if you're a late stage company today, if you're not profitable or you don't have a very clear path to profitability and fundamentally a high quality business, you're just not going to raise any capital. It's over.
You spoke about this in the last chat with Sanjeev also, which is make profit at a very unit level of whatever it is that you're trying to sell. And, that was a very powerful statement that Sanjeev made, and you expanded on. What does this imply for founders generally in their business? How should they apply this in their lens? We talk about contribution margins and all different kinds of contribution margins, growth margins, etc. How do you stay realistic towards this goal to the most bare unit of saying, at every unit, just be profitable? What's your advice to founders as to how to?
Look, if you're an early stage company, right? Let's say you've just launched, or you're in the first year or two of your building your company, right? You may have, especially in, let's say, a consumer business, a vertical commerce business, you may have negative contribution margin. Right? Contribution margin, look, there's only one contribution margin. Okay, it's after all variable costs, including cost of goods sold, including variable marketing, including customer support costs, things like that. So with the exception of very few industries, like for instance, if you're trying to build a vertical marketplace, okay, it is very likely in your first few years you're going to be a negative contribution margin because you have to live, you have to try and build it out, right? But for instance, if you're building a consumer brand, okay, across beauty, fashion, food, etc., right? Look, you have to be CM positive after marketing. I mean, very early in the game, like we wouldn't make a seed investment in a company, right? Let's say you're at 50 lakhs or 1 crore a month as a consumer brand, and your contribution negative, CM2 negative. We won't invest in the company as a seed investor. You know what I mean? Now, of course, 50% of the companies that we invest at seed are pre-launch, but those tend to be software companies and, fintech companies and things like that, AI companies, which generally tend to be much higher margin, right? So I would say, look, this is not complicated, Ablesh. Every unit that you're selling, are you profitable or not? I mean, it's a pretty simple thing, right? Like, who on earth wants to be in a business where you'll make money, where you lose money on every unit you sell? By the way, what that really means is the faster you grow, the more money you lose. Okay, now that was permissible, if you will, or that was happening in our ecosystem for a very short period of time, right? Like let's say 2021, first half of 2022. But that period is over now. We're back to building real companies.
No, I totally agree with you. Just wanted to get your views on how does this apply in the context of founders in a slightly different categories, founders who are, with moonshot ideas, founders who want to go after deep tech ideas.
Basically, if you're building deep tech companies, right? 1/3 of our investments now at Surge. So at Peak 15, Ablesh, so I spend all my time at at seed stage, and we have a platform called Surge. We're 4.5 years into it. If you look at our next cohort, which starts in a couple of weeks, right? About 1/3 of the companies are just deep tech companies, okay? So think about green hydrogen electrolyzers, think about semiconductors, think about last cohort, for instance, we had a lithium-ion battery recycling company and so on, right? These companies, look, firstly, they take longer to just even launch, okay? Because you have to first build the tech. There's no revenue, right? So you have to actually build the tech. Then you have to go from tech, TRL level 1 to level 10, then you got to launch. But once you've launched, if your gross margins are negative, that's a problem. So if you're a deep tech company, look, the reality is it could take you 2, 3, 4, 5 years to just build the technology, right? You have no revenue. So there's no question of what contribution margin is, what gross margin is. But after you launch, right? So especially if you're a deep tech company, so it's very important for the unit economics to work, right? Because once you launch, then it's still quite similar. But I think the difference between deep tech that has longer R&D cycles and let's say building a SaaS company or launching a new consumer brand is, look, if you're building a SaaS company, look, in 6, 12, 18 months, you launch the company, right? unless it's a very complicated sort of AI product. But in deep tech, it's almost always the case that you're going to be developing, for several years, right? Could be 2 years, could be 3 years, could be 5 years. In our next cohort of search, we have a company that was been building these machines for 7 years. Okay. And we invested about 6 months ago, but now they actually have launched. So now they've launched, the company actually has very strong unit economics. So once you launch, you want to make sure that what I call the math works.
On that note, we spoke a lot about new age tech and venture capital. A very quick view, Rajan, on the non-VC fundable businesses. Turns out there are quite a lot of them. Where do you see the real potential for such businesses?
I mean, everywhere, Avlesh. I mean, look, basically, India is made up of businesses that are actually family-owned businesses that got bootstrapped, got to profitability, etc. Right? I mean, I often say this, right? The two happiest entrepreneurs in the Indian startup ecosystem are Nitin and Nikhil at Zerodha and Sridhar Vembu at Zoho. And what do they have in common? They're both bootstrapped. Both companies are insanely profitable. They're without question market leaders in their businesses, and they're both incredibly happy. So they do things. Nikhil runs a 5-hour podcast. Sridhar is, sort of investing in lots of interesting deep tech companies while he's obviously growing his business, right? So, and these are just two examples. So my view is, look, if you look at India today, what sometimes we forget, Avlesh, is India is a $3.5 trillion economy. Okay. In the next decade, we're going to add at least 1.5 trillion and more likely $2 trillion of GDP. Okay. Right. So in this kind of growth environment, everything is growing. If you can't build a business thoughtfully, right? Then there's something wrong, right? But generally what it means is that you don't really have that deep consumer insight or insight into a business need, that you're solving a real problem, right? Like Sanjay Bikhchandani talks about it. The best form of funding is your customer's money. Get your customer to pay for it. Now, of course, if you're a bootstrap company, you will grow slower, which is perfectly fine. So we think whether it's consumer brands, whether it's software, whether it's financial services, you name it, right? With the exception of, let's say, a product where you have to invest tens of crores in R&D, right, to build it out. That's hard to kind of bootstrap because you do need to raise capital, and it could be in the form of grants. And over time, in the case of funding, in every other sector, Avlesh, right, the possibility is just extraordinarily possible, right? And actually, we tend to look at, call it the 10,000 venture-funded companies in India. But the reality is, there are millions of businesses in India, right? Let's forget about the 75 million SMEs. I'm talking about there are millions of businesses that generate hundreds of crores of revenue. Okay, minimum. Think about that.
No, I agree. The whole idea of venture capital is romanticized quite a lot in the last 15 years or so. But yeah, we tend to forget that businesses have been built before that and will continue to be built after that. Most founders, I think, even a lot of people who come to me, when I ask them to just go ahead and build it, try not to raise capital. It's not perceived very well. And it's just, I think, it's just a very different echo chamber we all live in. But you're absolutely right. There's tons of opportunities everywhere. Coming to our topic, our entire theme, our sole reason for existence as a company, the very topic of retention. And I know you've been very vocal about this in the past too, as retention, user retention being the key driver of building an enduring business. What's your view, Rajan? How should companies think about this? When is the time to think about retention? A lot of people start thinking about this much later in their journeys and in building companies. How do you advise people when it comes to user retention? What is the lens they should put on?
Look, I think the first thing to keep in mind is the only way we as investors measure the quality of a business, I'd say the most important way in the early stages is retention, right? It's repeat buyers, it's repeat transacting users, it's account renewals in a B2B enterprise, it's net account, NRR, net revenue retention. So whether it's a B2C company, whether it's a B2B company, retention and renew, basically it indicates whether a customer, be it a consumer or a business, continues to buy your product and pay for the product. And ideally, over time, we'll continue to buy more. And, if you're a B2B customer, we'll continue to consume more and pay you more, right? So that is super, super important. So firstly, it is the essence, the core of a business, right? I think the second thing to keep in mind is it's very important to start working on it early. Actually, if you're an early stage company, if you don't focus on retention, you won't get to PMF, right? It's easy to acquire users. Look, today in India, there are 700 million active smartphone users, okay? They're all on 4G networks. In fact, if you add up Jio and Airtel's announcement last week, they've crossed 50 million. India today has 100 million 5G users. Okay, so we have 700 million smartphone users, Avlesh, monthly active. It's not total installed, monthly active. 600 million on 4G and 100 million on 5G. Acquiring users is not a problem. In fact, if you can't get 100 or 200,000 users, I'd be worried. Have you really built anything? But getting those users to come back and re-engage with your product and then, continue to buy the products that you have becomes very, very important, right? So the simplest way I think about it is the most powerful growth lever that a company has. And I'm always amazed that one question I ask is, how much are you spending on acquisition versus retention? And the answer always is they're spending 10 times more on acquisition. Actually, that to me is an indication that you have a low quality business. So one thing you guys should do with all your clients, Ablesh, and maybe all the CMOs in the room is look at two numbers, okay? How much are you spending on acquisition and how much are you spending on retention? Ideally, if you're a late stage company, that number should be 1-to-1. Very few companies have that, okay? The companies that have that, Ablesh, where what they spend on retention is actually more than what they spend on acquisition, guess which those companies are? Google, Facebook, Amazon, the best consumer franchises on the planet. If you're spending 3 times or 4 times more on acquisition than you're on retention, you have a leaky bucket. You have a product problem, or you have a support problem, or you have a delivery problem. You got to fix those things, right? Because that's not a good sign. And I think that is the flip. So there you go. Now you have a new metric, Avlesh, for you and your teams with your clients who are in the room, which is what is that ratio? By the way, what is that ratio in your clients, Avlesh?
The minimum that I can think of, Rajan, is 5:1. This is probably the best in class companies. If I had to just pick average number, I would say 10:1.
Yeah, there you go, right? Those are not high quality businesses. Those are not high quality businesses.
It's also a little convoluted, Rajan, in the way companies do this. And, Google and Meta, they've built their business by doing this. A lot of times what the common wisdom on users that you've already acquired once, people still today, the CMOs still today will go back to Google and Meta networks to get the same users back. If, in cases where they go dormant, when they don't buy again, etc., they would want to bring them back through those channels. It's just that, these habits have been built over decades. And people tend to think that that's the only way to bring them back. Now, call it acquisition spend or retention spend, that depends on what lens you're wearing. If you wear a lens saying, these users I had already lost, and now I'm kind of bringing them back, you think of it as reacquisition money that you spent. But the point is that you had already acquired these users. You already know who they are. There is no reason why you need to go to a Google or a Meta.
Look, I think, no, obviously you see this, right? Look, it's called lazy marketing.
That's right.
It's lazy marketing. I mean, if you're a CMO that's spending 5 times as much on acquisition than you're on retention, either you have a product that is low quality or you're a lazy marketer. Those are only two things. There's no middle ground.
Yeah,
by the way, I'm talking about a scale company. I'm not talking about early stage companies. Early stage companies, obviously, you have to build a user base, right? You can't retain users if you don't have any. So in the early stages, of course, you should be spending 10 times, 20 times, 30 times on acquisition versus retention because you're trying to build a user base. But if you've been in business 5, 7, 10 years, you've got, let's say millions, if not tens of millions of users, be they transacting users or engaged users. Now you should be really focusing on retention, right? Look, retention is much harder, right? Acquisition is easy, right? Like you spend on platforms and look, you're going to get users. But the key question is, are they coming back? Ideally, by the way, they're coming back organically. The best companies in the world are spending very little even on retention because organically users are coming back. Now, that's a very, very unusual thing. So you do have to, do what it takes to actually drive retention as well. So there you go. Now you have a new metric. By the way, what you should do is do a audience poll. Maybe you can do a poll. I'm obviously not there. Unless you can do it. To see, get a raise of hands of how many CMOs in the room are spending, let's say, 10 times what they are on acquisition versus retention. How many are doing 5 times versus how many 3-to-1 and then 1-to-1. You should give awards to the 1-to-1
Yeah.
Especially if there are companies that are doing well, okay? 1-to-1 and companies are doing well, that doesn't count.
Yeah. No, absolutely. We are actually going to run a poll after this session is over. But as always, Rajan, it's always amazing speaking with you. There are all these founders and team members from startups in the audience today. We have thousands of them, and the morale in the ecosystem has generally been sort of very low for the last year or thereabouts. We have been talking about all the terrible things, layoffs, companies not doing well, too many news of regulatory compliance issues in companies. You've always been a great source of inspiration, and we could always use some advice from you. So please, for the audience, we'd love to hear a few words.
I'll end with this, right? We're in the fastest growing large economy in the world. We have 700 million internet users. 100 million of them are already on 5G networks. So we have the fastest 5G rollout currently happening in the world. We don't have the largest 5G on a percentage basis, but the fastest growing, right? Our ecosystem has dramatically changed. Avlesh, when I joined Google in 2011, the entire digital ad market was $140 million, okay? That was 12 years ago. Last year, the digital ad market was 8.5 billion. And at the current growth rate, the digital ad market in India is going to be $25 billion, okay? 2 lakh crore by 2030, right? So you could really not be in a better environment. Of course, raising capital requires you to build a high quality business. So I'll end with this. There's never been a better time to build, but you got to focus on one simple thing, which is build a very high quality business. Thank you, Avlesh, for having me, and have an awesome rest of the day.
Thank you, Rajan. Always a pleasure chatting with you. And thank you so much for making an appearance. We did miss you being here in person, but next time we look forward to see you. Thank you so much.
WebEngage. Retention simplified.